Going live here. Hello, everybody. It's Brent here with my good buddy Darius. How you doing?
What's up, man? How you doing? It's good to see you.
Good. You and I were chatting, and it looked like there was a pretty interesting close there. The market's moving around a lot, and so we appreciate everybody joining us on right after the close, right? On a pretty wild few days. So you and we talked last January. We were discussing this, and it was right after OPEX. The markets had really crashed into that options expiration. And then we had the Fed those couple days after. And you and I talked the day after FOMC. We both felt like there would be a pretty good bottom in the markets. And we had a pretty strong rally right into that end of January, beginning of February. This situation is different. Here, we're getting a rally into the FOMC or after the FOMC. Now we're having OPEX tomorrow. And now there's the Ukraine situation and all that. So I'm going to leave the tough questions to you. But we're going to start quickly. Before we dive into it, why don't you just quickly tell people how they can reach you rather than wait till the end. We'll just clear that off here. I'll show up on the screen your contact information.
Nice.
Yep.
Yeah. So let me start. Let's take it before we even get into the program. I just want to thank everybody for joining us. Obviously, there's a lot of really bad stuff going on in the world.
Very good point,
folks. Russia, Ukraine. I'm been sick to my stomach, all day about the theater over there in Ukraine. That's a really awful instance. So, with all that being said, I want everybody to realize, look, we get to do something that we all love to do, and we have to be very thankful and because we are blessed, So, with that in mind, I want everybody to go grab a drink. It's after the close.
There you go.
I have a glass of Whispering Angel. We're allowed to enjoy ourselves. We're allowed to enjoy our lives, and we have to be thankful for these opportunities we get to connect with all of you, with each other. So let's get into it.
Yeah, and good on you for taking that pause. I tend to start going a million miles a minute, and it's good to take a minute to reflect. I guess that's what Whispering Angel does for you.
Indeed.
So Darius, his contact information and my contact information is up there. We can do a little bit extra at the end as well in terms of the intros, but we'll kind of jump into it. So our goal here is really, the same as last January. There's this confluence of events, which is a lot of options expiring. I firmly believe, and I think Darius sort of subscribes to this idea that the options market can have a big impact. It's not every day. It's not every single move related to options expiration, options flows. But on days like this, where we have, billions of dollars notional value of options expiring, like we do tomorrow, that options tail can wag the dog a little bit. So we're trying to explain how these big options positions play into the macro picture that Darius understands so well. So I want to start off just talking a little bit about where we've been. Again, it was interesting in January because we had huge single stock in the money calls expiring. We thought that would bring volatility, and we had this concept of a lower bound. I saw it in my work. Darius saw it in his work. And that lower bound really was a bouncing point for markets, again, into the end of January and the start of February. We were talking through March about the same thing, and this idea of a lower bound, and that lower bound was around the 4,100 area. We saw that would be hard for the market to kind of push through that level because there were such big hedging positions. Now, those hedging positions were added in January, right? They're quarterly options that were added, and they were what we believe added support. The market was worried about what the Fed would say in March, how many hikes, rate policies, etc., and hedges were added at that point. And in our view, that is why when the Ukraine situation really kicked off on February 24th, there was an initial drawdown that day, right? But the market has spent the bulk of March above that February 24th low. In fact, I think that is just the low that we've seen. In other words, the Ukraine situation is a tail risk, obviously, from a market's perspective. I don't mean to sound callous here, but it's a tail risk. The main course, what people were really focused on was what is the Fed going to do? So we talked about this lower bound. We talked about the idea that it would take a while for the markets to grind down, and we've been flagging, that's what we're showing here on the screen, March OPEX as this opportunity for these puts to release and the market to rally. One of the charts that's gotten a lot of attention from people is this concept that we have here of delta tilt. So for delta tilt, we look at the total call delta and we compare that to the total put delta. Now, when the chart or the indicator is down near the bottom like it is here, that is telling us that there are a lot of deep in the money put options. Put options are sort of maxed out, right? And so what happens is, again, if you bought puts in January, worried about what the Fed may do or whatever else is happening in the world, you own a 4,400 put or a 4,500 put and the market drops, suddenly that increases the put delta that's on our indicator, right? We're going to show another example slide of this in a second, but basically you can see that when you look at this as a lower bound compared to the March of 2020, crash, as well as December of 2018, there appears to be sort of this, maximum level of protection, right, that the market needs, right, or invokes. And after that, it's like everyone's hedged and we can't push on that lower bound. So we flagged this about 2 weeks ago. This metric now with OPEX, we should see this green line bounce sharply, right? About 30% of this value down here we should see as a bounce because so many in-the-money puts are expiring. Mm-hmm. A few weeks ago, too, we talked about this. You can go on our YouTube channel. We also did a Contrarian Investor podcast where we talked about this idea that the market had a lower bound in place, and that's really what the idea is here. Again, you can see on this chart that the VIX did make a high after the invasion, the Ukraine invasion, but the market really has not punched lower. And this is despite the addition of a lot of credit concerns, right? And this is, again, I think Darius can really talk about this in a lot more detail and depth. But there's a lot more risk in the market, you could argue, but the equity market did not make a new low. We talked about the MOVE index, credit spreads, et cetera, some of these other signals that the average guy like me can look at and see markets are worried about this tail risk. But again, we got a little China stimulus this week, or talk of China stimulus. We got an FOMC that was, I guess, in line with expectations. Again, I'll leave Darius to comment on that. And we got a humongous rally. What happened? Vol got crushed. Implied volatility got crushed. All these big, deep in the money puts, right, suddenly started to lose a lot of value. They're decaying rapidly as we approach Friday's expiration. And bam, we get this humongous rally. It's just a pure short cover rally back up into this main resistance area of 4,400. Which we've been flagging because that is basically a level where we see gamma, that is hedging resistance, flipping from negative to positive. And that simply means that the easy money has been made in our view, or the fast money has been made in our view. So as an example of puts and how they got crushed this week, on your screen here is the March 4,000 put. Pardon me there. Earlier this week, this is a Monday in this area, that put was around $20 a contract, right? And this was the market around 4,200. You can see that as the Chinese stimulus came out and the Fed, that put got absolutely decimated. Now, there are 100,000 of these puts that were tied to March expiration. There are also, and I have this detailed in another slide, tens of thousands of other puts in and around the same strike. But this is just an example of the fuel, right, for this short cover rally. These put buyers feeling okay about their position probably on Monday, and suddenly these things got eviscerated, and that hedge is obviously going to go out worthless. 100,000 of these 4,000 puts are expiring. That still leaves about 200,000 left that expire later in the year. Again, Darius here, we're looking at, this chart is from Goldman on the top. This is the notional value of options. This chart is from Monday, I believe. So this has changed a little bit, obviously, with spot changing. But the point here is that the bulk of options values, both puts and calls, sit at strikes above this level. One thing I want to point out is the node, I call it, at 4,000. Again, this 4,000 put was eviscerated, as well as a lot of these strikes kind of in where I'm putting my cursor here. So this is all out of the money options expiring. Excuse me, out of the money puts are now worthless. We have some in the money puts that are still set to expire, which is some of the delta bounce that we could still get. But these values have all changed drastically over the last 5 days. Now, again, on this chart here, I've measured. This is total put open interest as of this morning, and I've marked how much is set to expire. That's 100,000 of the 4,000 strike puts are set to go away on Friday, 15 of the 4150s, etc. So this lower bound concept, right, is now being reduced. The power or the force of that lower bound, that green line we showed on the tilt chart now, we have more capacity for new put options to come into the market and for some more downside hedges. And so what we're really trying to get at, and on this chart we note, if you have an in-the-money put, right, because you bought it in January and you need to systematically re-hedge, you're going to take your 4,500 put or your 4,600 put or whatever the strike that is, and you're going to roll that, what's called down and out, right? I'm going to sell that put, or it's going to settle. I'm going to pocket a bunch of cash, and I'm going to buy a new put that is struck, say 5% down out in June or whatever it may be, right? I'm going to roll these puts down and out. That's from an options perspective, that new put you buy has a lot less delta, and that clears, again, sort of cap space, right, for this new lower bound. And that is the flow that we think is going to start coming into the market here. Now, we talked about the idea briefly of the Fed pulling forward some of this OPEX rally. If you just flip back to this chart again, if you remember January, and this is the January situation here on the chart, we were careening down into the Friday expiration, and we historically talk about the Monday bounce. We talked about it in the January video, Darius, that we did, that there's big market reversals often come after major options expirations, notably March of 2020, December of 2018, January of this year, right? Monday was the low, and then we get this bounce. In this case, we've gotten this rally where vol's been crushed. Just look at the VIX. Vol's been now crushed. These puts are getting destroyed, right? All these put values are getting destroyed. Now, there's still a bunch that are in the money, as you can see here, but those values are sharply down from when this chart was taken 5 days ago. And so I've been using this phrase, the Fed or FMC's pulled forward a lot of that OPEX bounce. And so as a result, and we've been talking about this in our subscriber notes, this idea of an OPEX Monday bounce, we're kind of discounting that a little bit because of the fact that we think a lot of that move was already, so to speak, pulled forward. Now, I don't know if we want to go through some of your stuff, but I'll give my preview of what happens after this, and I think it'll dovetail with what you're saying. Eyes are on the 4,500 strike now for March 31st. That's that infamous JP Morgan trade, right? The collar that's right around 45.10, I believe. But if you just look at the profile of gamma and implied volatility, et cetera, above 4,400 is where gamma starts to pick up positively. The flow or that tailwind of what people like to call VANA, right, which is the decline in implied volatility that really eviscerates put options and gives us fuel for market rallies. Now at the VIX at 25, that fuel has really been sharply reduced, right? So you're going to have gamma pick up above as we move into 4,500. That gamma starts to tighten down volatility, serves to support the market, but also reduces the amount of upside you're going to get, right? You're not going to get these 4 or 5% moves or whatever over 2 days. We'll get smaller moves. And I think if we get in that 4,500 range, particularly into the end of the month, that's going to be a top. Now, below, because we've had this put reduction, once we kind of clear out of the OPEX move, I think Monday, Tuesday, we now have a new area for a new lower bound. We have room for a new lower bound. So where 4,100 area was this lower bound, we think that lower bound is now around the 4,000 strike. So if we start to sell off for some reason, Monday, Tuesday, Wednesday into next week, the ability for the market to really slip lower to get a bigger move, right, than we've seen over the last several weeks. Because again, we talked about this before, there was never like a capitulation move into all of this, right? We were steady down 1 or 2% every day. You know, we go up a few percent one day, 3%, and we drop it back down. There was never this puke of just capitulation that took place over those last few days. So now we have what we see as an air pocket down to around 4,000, which is roughly down 10% now from here, right? After these rallies over the last 2 days. So that lower bound, which we've written about, is now lower. The other thing to note, and I'm going to turn it over to you, Darius, after this, because people are dying to know post-FOMC, what's up. If you look at realized vol, 30-day realized vol, it's in and around 25-ish, right? If you look at the money implied volatility, or we'll just take the VIX as a very rough example of what I'm trying to talk about here, that's roughly around 25 too. So realized vol, you're probably not going to have implied volatility or really the value of options that are going to be less than what realized volatility has been. In other words, the market is having all these major moves. There's some event premium in volatility because of the Fed, some tail risk, obviously, because of the Ukraine situation. But the lower bound for implied volatility is basically akin to how much realized volatility or how much movement in the market there has been, right? That realized volatility is in the, let's just say, 25 area for sake of argument. The VIX and implied volatility, if you look at the money implied volatility in the S&P, is now down around that 25 area. So options now have reduced the event vol premium from the FOMC quite a bit. You need to keep a implied volatility event risk kicker for the Ukraine-Russia credit saga, all those unfortunate events. So how much lower can implied volatility really go from this level? Obviously, it could all start selling off if we get positive news on peace talks or whatever it is, then all bets are off. We're going to rally, some, and this is where you pick off again. But my second real just point here is that we've zapped implied volatility, and I think it's at a lower bound. Unless we get a peace resolution, we are at a lower implied volatility bound. However, you could also say, look, puts are now cheaper, right? Because I'm going to start buying a put with the market up around 4,400 and implied volatility, down, 10 vol points, 15 vol points from where it was just 2 days ago. Long puts now are much more attractive, much more interesting. You could argue from that perspective. So that is my 2 cents laid out on a bunch of slides here. If you have any questions or comment on that, Darius, you want to talk about it now, we can. If you want to shift to your presentation, world's your oyster here.
Absolutely, man. That was really good. Thank you. Thank you. Just a reminder to all the audience, welcome, and thank you again for tuning in. Just pop your questions in the comment section. We'll try to get to as many as we can for the end of the program. I have one question for you, Brent, before I get going. In terms of like sort of this, you just mentioned the last thing in terms of puts being a lot more attractive to buy for the end customer, for the investors. Obviously, the dealers know that. So what's the sort of step? Walk me through the sort of psychology of dealers right now and the steps that they're going to take to not effectively get fleeced in this particular market. Because obviously we haven't removed a lot of the macro headwinds that I'm about to speak to.
Yeah, and I think a lot of it is simply a function of risk, right? If you are a dealer or a market maker, you have essentially a portfolio of options, right? Just like any other hedge fund or personal or whatever it may be, right? You have bounds or risk limits that you want to take. And when your book starts to get full, right? When your inventory gets full, you're going to widen your markets out. You're going to raise the price of options. So if you start getting overloaded with put options, you're going to start making those options more expensive. You're going to raise the cost of those puts. Now, options expiration is going to wipe out a lot of that positioning, right? So there's more capacity, arguably now, or more inventory, you could argue, space for dealers. We mentioned the SPY dividend. I specifically told you I wasn't going to talk about it, but that's happening right tomorrow. So that's a factor that comes into the spiders. The spiders is a very big options complex. So there's some adjustments going on around there now. Anyone getting assigned options, calls or puts, obviously, into this weekend, they got to adjust on Monday. So there's a lot of just technical positioning stuff that doesn't really have anything to do with risk. Now, I think that everybody understands the tail risk here, right? I think a lot of people, unfortunately, bring up the fact that nukes are now on the table where they weren't before, right? Credit risks are much bigger. And so I think, again, we're going to have this implied volatility edge. And if the dealers can charge that extra edge, they can keep spreads a little bit wider. They're still making their money, right? Wider spreads, lots of volatility is good for them. They're hedged. That's all great. So in my view, the options expiration just kind of resets their inventory, gives them capacity, right? Their warehouse has space. They can charge a little bit extra still because of all the things that are going on. There's a little bit more demand for protection. But all in all, I think that this is a place where, again, that max delta is kind of cleared out, where the market was sort of full up on puts before. We've reduced that supply by anywhere between a third and half. And so there's more capacity, I think now more space, to start buying puts for people, and that pushes the lower bound. Buying a put over the last couple of weeks just didn't make any sense here because implied vol was so expensive. Trying to buy puts down in this area, the puts were so expensive. The odds of you making any money on those puts was just really small, right? You almost needed that tail risk, and a lot of people are really trying to cash that tail risk, but the odds were just really against you, right? Just like you don't want to short in the hole. Buying a put when implied volatility, the VIX is up around 35 and the market's already dropped 4 or 5% is just not that attractive. And in a similar vein, you talk about call options. It was hard to buy calls off of these lows with vol so expensive as well because, if the market rallies, depending on exactly what call you buy, that can be punitive as well, that implied volatility coming down. So we're sort of resetting the board, I guess is what I'm saying in a large way here. There's still some good put positions on, as I mentioned in that slide before, but the lower bound now I think can stretch a little bit lower.
Yeah, that makes a lot of sense, man. Thank you for that. Even before I get into my presentation, let's start here and keep it in the derivative space. So you mind if I show my charts here?
100%. Yep.
Thank you, Brent. So this is something we produce every day in our leadoff morning note. The chart on the left, or both charts, but the chart on the left specifically, we show our crowding analysis through the lens of the volatility risk premium on the y-axis and the deviation, the 1-year deviation on a z-score basis in 2-month 25 delta skew. And the one thing I'll call out, if you kind of zoom in and follow my pin here, you see that both the SPY and the QQQ have depressed skew and implied volatility discounts in terms of how we calculate and we look at 30-day at the money put vol relative to the mean of 10-day, 20-day, and 30-day R vol to construct a kind of a hybrid surface, if you will, without destroying my computer. And so the one thing I'll call out is that, hey, look, investors are very clear that the dissipation of volatility, the reduction in vega risk has really made buying new puts attractive, rolling down and out, going to June or going to May, going wherever they're going to go in terms of extending the maturities of those these expiring put options, and then going down in terms of giving them some incremental protection to the downside. That's an extremely attractive trade right here. And so the dealers are aware of that. And I don't think it's a conspiracy theory, but I also think that dealers are financially motivated, they're profit seeking enterprises, and they understand this outcome. And so guess what? Well, we typically happens whenever we get financial markets in this lower left quadrant where you'd have depressed skew and an implied volatility discount, you tend to see elevated risk of a correction, a meaningful correction, a big enough correction to cause a rise in implied volatility premium. If you're a dealer, you want to be selling options with a high implied volatility risk premium. You don't want to be selling options with a volatility, discount, implied vol discount. That's a problem. That's a problem for the business. And so, to me, the setup here, given that we've seen so much short covering, really be the driver of this rally. And I'll give you an opportunity to speak to your hero indicator after I present. But so much of this rally has been driven purely as a function of removing the sort of the tail risk associated with the March FOMC off the table. Jay Powell, he said he confirmed what he said with the Senate in terms of, hey, look, inflation is the new priority. We're going to do what we have to do to maintain, to get price stability back in line. And ultimately, that in and of itself was not the introduction of a new bear catalyst. If you had a new bear catalyst, then all hell would have broke loose. However, the lack of a new bear catalyst is a bull catalyst in the context of OPEX being Friday, with so many puts that are in the money, puts that are expiring, that are obviously catalyzing this sort of Vanna and charm flow. So without further ado, sorry for that, but getting to my slides, so I put together a few slides here. So we are on slide 115 of our March macro scouting report. We put together one of these presentations every month. It's usually somewhere around 100, 125 slides of kind of summarizing the medium and long-term macro risks that we see out there that investors, one, certainly should be abreast of, but two, what we're trying to do is also help them take advantage of that in portfolio construction terms. So kind of adding these slides, to here for today's discussion. I'll start with saying, kind of where are we? What's the sort of, kind of 30,000 foot view of where we are? And we're talking about, okay, where are we in the financial condition cycle? What's the market cycle? So I'm showing here in this red line is the Goldman Sachs Financial Conditions Index. And it's kind of like the VIX, or at least in the sense that a high value is negative for markets, a low value is very positive for markets. There's things like credit spreads, volatility, equity valuations, things of that nature in the index that sort of give investors a sense of, okay, how much have those types of signals deviated from their recent trend? And the reality is, one, we're coming off an all-time low in the index. This data goes back to 1986. I was born in March of 1987, so that's a very long time. In the conditions in terms of what the Fed, the kind of hay the Fed has to bail to tighten the economy and ultimately tighten financial markets and financial conditions is pretty steep, right? You look at this 98.4 reading, we are right where we were at the peak of the dot-com bubble. And so you talk about having the NASDAQ having already crashed. S&P, I think as 3:30 this afternoon, was down 9% from its highs. NASDAQ was down 19%. Russell was down around 20%. We haven't seen anything yet in terms of tightening financial conditions. We are at the peak of the dot-com bubble. We're not even in 2016, 2018, 2020, 2011, 2008, obviously a lot of stuff, 2002. We have a long way to go before the markets and financial conditions are really tight. And this is, again, a function of how overvalued asset markets were heading into this event. So that's a problem. On slide 116, so we got the update from the Fed yesterday. I think sort of one of the most important statement was that we got clarity that the Fed was prioritizing inflation over growth. And so the key takeaway in terms of them prioritizing inflation over growth just means that, hey, they're going to tighten until inflation comes down enough for them to stop tightening. Well, from my perspective, just given our inflation forecast, and we can dig into that in the Q&A. From our perspective, based on our models, they're not going to get a signal from inflation to stop tightening. which means that either the unemployment, the labor market in terms of their second mandate, or their hybrid third mandate as it relates to financial stability, are the only two sort of feedback channels that the Fed is going to receive to stop tightening. Well, guess what? If they cause a problem in the labor market, that's recession. That's what a recession is a problem in the labor market, in so many words. And so clearly that's unlikely to happen before financial markets tell the Fed to stop. And so our core thesis, and it's been our core thesis for a while now, which is the financial markets are the only conduit to tell the Fed to stop doing what it's doing. And so we now just got clarity, in our opinion, that the Fed is going to do what we think it's going to do. So this takes me back to this chart, which is the dot plot. What I'm showing, the blue line here is the 2022 median projection for the end of 2022. Red line is the 2022, 2023, and the black line is the longer run, sort of their estimate of the kind of neutral rate in the economy. Well, as you can see, if you look at the 2-year projections, we are now back above the neutral rate in terms of what they're projecting from a policy standpoint. So effectively, the Fed is saying, hey, look, we are going to tighten monetary policy into a restrictive space. And by restrictive, I mean restraining financial conditions, tightening financial conditions enough to restrain, credit intermediation and obviously economic activity. So that's the one thing that's really important to call out, is that, hey, look, it's the first time we've seen that since 2018. Obviously, 2018 didn't end really well in terms of the Fed not really understanding where it was in the cycle. And I think, not to jump around the presentation, but I just want to hammer home this point. It's not clear to me that the Fed understands where it's in the cycle in this particular time. This chart shows the unemployment rate, the blue line. The black line shows the sort of labor force participation rate, and the red line shows the Fed funds rate. Most important part of this chart are all these dotted lines that show the onset, the commencement of a Fed tightening cycle. And if you look at each of those dotted lines in this chart and scan across from left to right, you look at, hey, look, the unemployment rate has never been this low prior in any one of those prior dotted lines. So what I'm saying is the Fed has never waited until this late in the business cycle to start tightening monetary policy. So the probability, if you take it, kind of one step further and look at what the yield curve is pricing in, which is obviously a slowing economy that's, 10s, 2s, 24 basis points from signaling recession, and 5s, 30s, 31 basis points from signaling recession. The yield curve is clearly pricing in an economy that is slowing cyclically, perhaps slowing cyclically to a below trend state. And there's a Federal Reserve that's just now getting going with respect to tightening monetary policy and ultimately shrinking its balance sheet. So that takes me back to, kind of where we are here, which is, on slide 118 here, we have to be acutely aware that, there's still a lot of tightening to come. Yesterday's 25 basis point rate hike was priced in. It's nothing, it's ho hum from the perspective of rates markets. But the reality is every step we go forward in time, we're pricing in more, we're going to get more tightening. We're going to get more balance sheet reduction. And those things are pretty negative. But the one thing I will say in terms of the near term setup, and again, if markets are very clearly being driven by headline risk out of Russia and Ukraine, we had a big rally because they were going to cease fire, and then there was a big sell-off. They were going to cease fire, and then Russia made the bond payment and avoided default. So clearly, right now, we're sort of trapped in a headline risk trading environment. But the real thing, the tail wagging the dog, is ultimately going to be the shape and slope of the Fed's balance sheet. Right now, if you're a bear, you have to be a bit concerned, just given what we're showing here in this blue line is net liquidity in terms of how we calculate it here, 42 macro, which is the Fed's balance sheet minus the Treasury general account balance. So Fed balance sheet at 8.9 trillion, Treasury general account balance at 630 billion right now. That number at basically 8.3 trillion is, in terms of, just looking at eyeballing a regression, it's, pretty significantly detached from where it is. So there's upside in the market here if you get a positive headline out of Russia, Ukraine. And that, in our opinion, is a hard sell signal in the context of this chart here. And this chart here just shows the VIX 6-month, 1-month term premium. So we're taking the 6-month forward VIX curve minus the price of the VIX on a 1-month basis on the front month contract. And what we're showing here is sort of as an indicator of how much sort of fear is in the market in any given sort of correction. And so typically what happens is the VIX curve gets backwardated, i.e. the price of near-term protection gets more expensive than the price of sort of medium-term protection, as denoted by the negative values in this chart. And the one thing I'll call out, and this far back as we can get the data, there have been sort of what I would consider to be kind of 12, meaningful corrections, kind of that the market has had to deal with, certainly throughout the course of my career, which kind of started right there. There's been 12 of these. We are less fearful at the nadir. I think this was the nadir was kind of like, that Jan low, I believe.
Yeah.
The nadir, or early February. If I'm not sure. I'm not sure which was nadir. But the reality is, we are less fearful at that most recent nadir than we were than 8 of the last 12 of these market moves.
Right.
But I would argue the setup is outside of 2008 and outside of completely shutting the economy down with kind of no real end in sight yet, at least in early March of in 2020. It's worse than all the rest of them. The setup is. And so to me, I think you have to go back. Okay, what's going to be the catalyst into to get the sort of next leg down started? And I'll be fair, very clear. It's we know that we've seen it already, a pretty meaningful tightening of financial conditions, just pretty much through food and energy prices. This chart here just shows crude oil, shows it on a trailing 2-year rate of change basis. And typically, what you see is that anytime we have a big deviation from the trend in crude oil, in 2005 is the lone exception, we have either a crash in the markets, we have a recession, or we have both. And so to me, and then last slide, and I'll shut up. The last slide, we just have to get to a place where, when does the market start to price in a sharper deceleration in growth? That will open up the new downside in the markets. And according to our models, we call it, the kind of June is like the first month where the speed of the deceleration. And by the way, we've been trending slower from an economic standpoint. We're showing the OECD Composite Leading Index time series as our proxy for growth. We've been trending lower since, July of 2021. And when that pace will start to pick up to the downside in mid to late Q2. And so what I'm effectively saying is, by the summertime, it's very likely markets are pricing in not just Russia, Ukraine, not just, steady Eddie Fed hikes, not even just QT. What's likely to happen by the summertime is that the market's pricing in, oh, poop, for lack of a better four-letter word, oh, poop, the Fed is actually going to tighten us into recession. Right now, it's just a risk. I think that'll become a greater risk, a greater possibility, morphing into a probability by the time we get into the summer and the fall. And so that's where the ultimate downside in the markets is, this disconnect between what the Fed sees, roses, rainbows, puppy dogs, as far as the eye can see from a unemployment and GDP forecasting perspective. But obviously that's unlikely to happen. And we believe that, over the next couple of quarters, next 2 to 3 quarters, we're going to have that reconciliation moment where the markets tell the Fed to, hey, back off.
There's I have a million questions, and for those of you also, if you put your questions in, we're going to get to them. We're going to start scrolling through here in a second. My one quick question here, I'm going to have a good idea of how some of your metrics change, like the dot plot, et cetera, but did anything substantially change from that Fed outlook? I mean, it seemed to me, we were talking earlier, that he basically met expectations, right? He didn't back off on the dovish side, right? He stayed basically as hawkish, so to speak, as you were anticipating with the forecast going forward, is kind of what I've taken away from what you've been saying.
100%. They just confirmed that they were going to be hawkish and that inflation is the priority. And in the context of so much sort of, put gamma, expiring in a near term, just the mere fact that they did not introduce a new bearish catalyst, it, allows you to cover those, or to, to buy, to monetize those puts, cover shorts. That's exactly what we're seeing in the markets. In fact, if you don't mind, I think it's a good opportunity to introduce your hero indicator, what we were talking about for the broadcast.
Sure. So what we saw today, this is our real-time options delta indicator. So every single trade that comes in, that's traded, we read what the hedging impact is, and that's essentially market delta, right? And that's the cumulative indicator you see on your screen. The blue line in this case is what the put deltas were. So if the put deltas are positive, that means people were selling puts, right? The aggressor, the person initiating the trade, was selling their puts. And conversely, if the line was going down, that would be put buyers. The call side works a little bit differently. If the call indicator is going up, people are buying calls. And if the indicator is going down, people are selling them. So what you could see happen today was a lot of put selling throughout the session. And then call flow in the spiders was very neutral up until the end of the day. There was this real big spike. I think that spike has to do with some of the spider dividends, right? You had to get some of your trades cleared up from the option side, assignments, exercises, et cetera. I think tonight before the dividend gets paid tomorrow. So I think that's what all that jostling was into the close. But we highlighted this yesterday and again today. If you think the Fed cleared the path for you or for markets to go higher and the Fed sort of tail risk or event risk is gone and the market is at its big drawdown, then you want to start getting long calls. And aside from some single stock, light single stock action, we have not seen this major like risk on appetite. Everything to us seems to speak of short covering, right? Squeezing. Let's sell some short-term options. Let's sell our puts. Puts are getting crushed. Vol's coming down. And so everything that we read seems to be people playing this bounce, right? This FOMC OPEX bounce thing is not necessarily a hidden secret here, but how can I essentially trap buyers able to get out is kind of in a way the way that we sort of see this stuff. And you brought up a bunch of really great points here that it's this rosy projection of the scenario where even if we get some peace talks, does that immediately clear up, all the risk issues that we're seeing, the credit risk issues that we're seeing, inflation? I think the Fed feels that's pretty much transitory, right? That seems like it's a nightmare situation. Even if peace talks start tomorrow, the risks, as you say, are much higher. And you had a great chart there of the VIX. I believe it was the 1 month, 6 month spread, and that we just didn't ever really break a lower bound that we should have. And again, we think that's because the market is just well hedged. The credit market, as we saw it, was really the move index, for example, and I don't know how much weight you put in the move index, but that was rivaling March of 20 highs. The Bank of America corporate credit spread indicator, was starting to shift up quite a bit. As you showed, the 2s and 10s are showing recession. So all these other things are, when the credit market starts to move, the equity market is going to go with it, right? And it just seems that we're not getting real risk on in the equities option space. And that seems to kind of dovetail into this, again, your positioning here that, okay, maybe we just sort of, I had this view in my head, right, of the Virgin Galactic, they take you into zero gravity, right? And the rocket ship shoots up there. And then you have this moment where, you pause in zero gravity and you're like, this is awesome. And then all of a sudden, all right, down we go, right? And I feel like that is kind of like the space we're in, where we have this window where I could argue that into like maybe end of March, or if we get close enough to 4,500, that gravity holds. But if you don't have this macro tailwinds, which it appears you don't, what's supportive of equities here, right?
Yes. So that's a great question. So let's kind of like put yourself as a neutral investor, right? Like a bunch of puts are expiring. You kind of don't know which way the market's going. Is it going up? Is it going down? Is the path of least resistance, higher or lower? And you start to say, okay, what have I learned in the past few weeks, right? On the bullish side of things, right, we have a Federal Reserve that is not going to, kamikaze, for lack of a better word, the economy just to slow inflation. They're content to take away the punch bowl at a measured pace, and albeit the pace will be pretty significant in the context of where we are in the business cycle, but it'll be a measured pace relative to kind of their ex ante, their Bayesian prior. We also have rhetorical commentary out of China, coming out of the Financial Stability and Development Commission. Vice Premier Li He, I want to say on Wednesday or overnight on Wednesday, came out and said, hey, look, they basically put a floor to Chinese markets. They said, hey, look, we need to start doing things that are supportive for Chinese stock markets. Obviously, anything that they do is supportive for the Chinese stock market is going to be interpreted as positive for Chinese growth. So the market is now on, if you're a bear, you're poop scared for a potential big easing initiative out of China. So those are kind of the two big bull cases, if you will. And then there's the last kind of the main bull case. Actually, if you don't mind if I put my charts back on screen.
No, please do.
There's sort of three the kind of bull cases, if you will. One of them we already kind of just talked about. The Fed removed the most aggressive hawkish right tail. The next bull case would be China saying it's a party. You look at what I'm showing in this chart here is 3-month Shibor in the blue. The red line is the Bloomberg China credit impulse, China's credit impulse, and then lastly, reserve requirement ratio in China. The reason I showed 3-month Shibor, the reason I think 3-month Shibor is arguably the most important statistic to come out of the Chinese economy is because most of the private non-financial sector debt in the Chinese economy is on bank balance sheet. It's not like the US where we have a very large and thriving capital markets, kind
Mm.
of, non-bank financial sector. China does not have that. China does not want that. It's a state command economy. 85 plus, 85% thereabouts of all credit is on bank balance sheet. And
Wow.
so the reason, the interbank lending rates really are the policy rate, if you will. And so what you typically see ahead of these sort of kind of globally synchronized recoveries, if you will, that are engineered by big easing initiatives out of China, you typically see like a 200 to 300 basis point drawdown in 3 month Shibor. That is a function of obviously the decline in reserve requirement ratios. It's a decline in open market operations. It's a decline in medium term lending. They're basically doing everything they can, throwing the kitchen sink to ease credit conditions in China, which ultimately, bottoms the Chinese credit impulse, the red line in the chart. And that's how you get going. And that's how the global economy resuscitates itself. Financial markets are doing well and everyone's saying hi.
And
Well,
there,
guess what's not happening right now?
I'm sorry, finish up.
Oh yeah, this is the last thing I'll say. It's just like, look at this. Look at this. Blue line barely budging. Red line is, kind of meandering. Black line barely budging. We're not seeing any widespread, wide scale easing initiatives in China. You typically, like if you want to say, okay, I want to buy the
Mhm.
news, you want to buy the news, or sorry, you want to buy the rumor of it. That's not been the right call. If you buy the rumor, look at where these dotted lines are.
Mm.
Late 2008, you could have lost 30% more of your money there. 2012 was not bad. 2015, you could have lost 15% of your money there. You could have lost 20% of your money in Q4 18. Right. So you need to see the whites of the eyes on these credit initiatives in China before you can actually get really bullish. And so what I'm looking for every morning when I refresh this chart is for a big move down in that 3 month Shibor rate, because that'll tell me that the PBOC is serious about following up to ease policy in China. You know
And
what I'm saying?
could you make the argument that they've already deleveraged quite a bit? I mean, if you look at the K Web and their equity markets and Evergrande and all these other things, I mean, is there any view that they've already deleveraged, so they're just ahead of us in that sort of experience, so to speak?
Kind of, but I mean, yes and no. I mean, right? I mean, so we know, the credit so we're still deviating higher. So what I'm showing you in this chart here is sort of one of our four horsemen of economic risks. We talk about demographics, balance of
Hmm.
payments, leverage, and politics as the sort of kind of four pillars of, structural economic risk. And leverage obviously is a big factor at particular points in the cycle. What we're showing the x-axis is the deviation from trend in the private non-financial sector credit to GDP ratio. So how levered is the private sector? And then the deviation from trend on the y-axis is, how what's the deviation from trend in debt service? Did you get a financial tightening or a financial easing? And as you can see, China's kind of in the wrong quadrant from the perspective of having a positive deviation from trend and a positive deviation in financial tightening. And so mostly, obviously, that financial tightening has come from declining incomes, not rising
Hmm.
interest rates. So you could argue, and this data certainly will argue, is that China has not really delevered. They just had a lot of capital evisceration from some overvalued companies.
Oh, that's
So
interesting.
that's an issue, right?
That's fascinating stuff. I have a few questions specifically for
Yeah.
you
Hmm.
from some people here. So Andrew asks, at what point are your estimates of long-term yields starting to decline instead of yields rising while the curve is flattening, which is happening now? Does that question make sense there? I kind of read it as the comment backwards.
No, no, not at all. Yeah. So again, right now the bond market does not have to contend with what we talked about earlier. Right now, the bond market is, hey, growth's fine, growth's fine, growth's fine. We're barely decelerating
Mhm.
on a trending basis. Growth won't be fine by the time we get in the second half of the year. And so ultimately, we do believe that as you get into that window of time, let's call it sometime between May and July, the bond market will start to look ahead and say, oh, no, wait, the economy is no longer this robust, rosy economy. I mean, I still find it comical, like literally laughable comical that Bloomberg consensus still has 3.6% as its GDP target for
Mm.
2022. I mean, the damn Federal Reserve just took theirs down to 2.8. How is the Fed leading Wall Street? I mean, these people get
Mhm.
paid millions of dollars to make up these numbers. So my point is my issue is that there's not only is there a realized growth slowdown ahead of us that is likely to pick up steam by mid-year, there's also a sort of growth revision cycle ahead of us as well, whether you look at it through the lens of the GDP cycle or if you look at it through the lens of the person with the Excel model open that's sitting ass to ass to the economists on the Wall Street floor trading desk. It's the analysts. The analysts themselves, if you look at taking a slide 95 here, S&P 500 operating margins are 200 basis points right now higher than they've ever been ever in the history of the S&P 500. And so, there's very clearly going to be some slowdown from the perspective of corporate earnings. But is that negative revision cycle going to come at the exact same time we're having a negative GDP revision cycle, while the Federal Reserve is not acknowledging the slowdown and still chasing financial or price stability? And to me, I think that's a big risk because, again, the Fed's not going to get any signals outside of financial conditions tightening to stop doing what it's doing.
That last chart there's it is something else. So another question here is the economy rolls over. So a couple questions on MMT here. So a couple of people asking if the economy rolls over and occurs into the teeth of basically midterms, is there a potential fiscal response or reaction, kind of like the MMT thing? Brandon also asked a similar question in terms of MMT and hiking rates against inflation or anything. Like, do you have any view on this MMT sort of stimulus view that could come out of nowhere?
I laugh at it. I mean, I'm not laughing at the question. It's a great question. I think that's as a bear, you definitely want to be aware of any sort of political risk, policy risk that can eviscerate your bearish positioning and your bearish thesis. That's certainly a risk, and I think it's a higher probability risk in Europe in terms of handing direct cash payments to help families cope with energy reductions and taxes on things like energy and all that stuff. Maybe that stuff could potentially happen here, but don't forget we have the narrowest margins of victory, or narrowest sort of margins in both the House and Senate in the history of the U.S. Congress. Joe Manchin and Kristen Sinema put the kibosh on the Biden the sort of Build Back Better plan on that October CPI print that went above 6%. Remember that I think we hit 5.9 or something, or 6% or 6.2 in October. That number came out in November, on November 10th or whatever. And I said, hey, look, this is probably it for Build Back Better. Punt that. It's not happening. Well, guess what? We're at 7.9% inflation. You think Senator Manchin's all of a sudden thinks it's a good idea to spend more money, or Senator Sinema thinks it's a good idea to hand out a bunch more checks? No, that's the reason we have this problem to begin with, is we handed out too many checks. So no, there will be no fiscal stimulus in the U.S. There might be fiscal stimulus in Europe, and to me, that's a really positive bull case that you would not want to fight. But again, I think you do still need to see the whites of the eyes on that dynamic, because again, don't forget, we still have PMIs in the mid to high 50s in most of these economies. There's a slowdown that needs to materialize ahead of us before we get that sense of urgency that you typically see out of fiscal authorities.
And all the issues created by the geopolitical situation, that those haven't even really read into the CPI data, right? So it seems like it's only going to get worse before it gets better.
Oh yeah. It's going to get worse in March, and there's no guarantee that it keeps getting worse. If it's going to be very difficult for inflation from this point forward to continue accelerating. If you look at it, so obviously, we run a couple of different models to forecast inflation. There's our stationary mean reversion model that's more in line with consensus, more in line where the Fed is. Our nowcast model, which looks at just shy of around 30 indicators to kind of project inflation. That's a little bit more high and sticky, and so you could say, hey, look, pick your path. They're both likely to be lower. Although I do believe the purple line, just based on all the market signals, that the purple line is probably more accurate than the black line or the blue line right now. And so in terms of, base effects, which is, it's going to be very difficult for inflation to continue accelerating on a year-over-year basis, right? Like look at this mountain of comps you now have to start to deal with once you get, deeper into 2022. It's that with median CPI, it's that with sticky CPI. So we're not going to stay at these levels. The problem is, and this is why I keep showing all of our inflation statistics on a month-over-month annualized basis instead of a rate of change basis, to a year-over-year rate of change basis, because the month-on-month annualized change is what the rates markets and ultimately the Fed are keying on to say, hey, look, job well done. I did it. Inflation's back on track. I can actually pivot. The Fed's not going to be able to pivot until we get, at the bare minimum, this blue line, which is the month-on-month annualized change in sticky CPI, significantly lower than the red line, which is the 12-month change, or until we get median CPI, which is currently tracking at 6.1% on a month-over-month annualized basis, second highest print of all time as far back as we can get the data, until we get it significantly below the year-over-year line that tells you that the year-over-year impulse is likely to slow on a go-forward basis. We're nowhere near that right now. We're still 200 basis points higher than that. And so there's still a lot of inflation momentum being built in the economy that, again, to me is the number one call of 2022, is that the Fed is anchoring on inflation and not realizing the economy is headed for a growth slowdown, or more importantly, may not care. And ultimately, the financial markets have to be the conduit to tell the Fed to care.
So it really is this idea of changing away from being asset supportive, which is really, the Fed put, so to speak. They just say
Yeah,
it's struck lower, and really that's what it is. I mean, that's it's really compelling.
absolutely.
One question here, which I think is a good one for us as we sort of wind up here. Um, Vincent asks, should we consider T-bills in lieu of bonds for fixed income in our portfolios? The last 3 months has a positive correlation between stocks and bonds. That is one of the most interesting things that I think has happened over certainly the last 6 months, is this idea of, the 60-40 portfolio. It showed shades of being broken in March of 2020, and it's not arguably working out all that well over the last few weeks here. And if the Fed's going to keep hiking, that could put pressure certainly on some of these bond and credit instruments. And so you gotta, this is why all the vol guys come out of the woodwork suddenly, like, come get my tail risk exposure, because that is the only hedge that's left, right? I mean, that's the Chris Cole sales pitch now.
Yeah,
um
absolutely. I mean,
what
so
do you, yeah, so what do you recommend in terms of that? Is there a safe haven in the bond market in any way if there is a drawdown,
yeah,
equity
so
drawdown?
the bonds will start to work when growth is under siege. Right now, growth there's a narrative on Wall Street that the U.S. is headed for recession.
Mm-hmm.
But when you actually look at the data that bond traders are looking at, the data that we're looking at, we would argue that the economy is still growing comfortably above trend. So there's no real reason to go buy a bond here with inflation at 8%. The problem is that what I just said about the economy growing comfortably above trend will not be true in 2 to 3 quarters.
Mm.
In fact, we could be comfortably below trend in 3 to 4 quarters, i.e., a potential recession. And so that to me is where at some point the bond market will have you start to look the whites in the eyes on the growth slowdown and say, hey, look, this is no longer an environment where you need to sell duration risk. It's an environment where I need to accumulate duration risk. And more importantly, going back to this sort of 60-40 portfolio dynamic, we've done a tremendous amount of work on this. It starts with our secular inflation model. I'll be quick. I don't want to wonk out. These are the kinds of conversations I have with our institutional investors. But we built a model that effectively is trying to quantify the sort of stationary mean of inflation. So what's the level that inflation should oscillate around that our inflation cycle in the U.S. Over the sort of kind of this decade, and in 2020's decade. And so if you think about the decade we exited, it's 1.8% at the 2010 and 2019 decade. According to the 16 factors in this dynamic factor model, we should be kind of tracking around 2.3 to 2.3 to 3% from a stationary mean perspective. And all I mean when I say stationary mean is that inflation is a sine curve. It's a periodic function. It's a semi-stationary kind of function, if you will. And so all we're trying to do is calculate, is that mean shifting higher or is that mean shifting lower? And our math would say that mean is about 50 to 100 basis points higher than it was in the kind of the post-crisis QE era, if you will. And the reason I bring that up is because right now we have a positive correlation between stocks and bonds. That positive correlation on a trailing 2-year basis. This is Bloomberg, the long bond futures relative to Dow Jones average as far back as we can get both data sets. And so that positive correlation, in our opinion, only exists as a condition of inflation being comfortably above that sort of threshold, that stationary mean threshold. What we saw going back to, the last time we saw a persistent positive correlation, that's the blue line between stocks and bonds. We kind of average, somewhere around 0.4% between kind of, again, as far back as we get the data from the late 70s all the way to the late 90s. The reason I believe, and this is my hypothesis, and Jurian Timmer over at Fidelity, I did a great Real Vision interview with him back in October, and he came to the same conclusion with a completely different model, completely different framework. And we both came to the conclusion that, hey, look, once you get around 5%, which is where inflation averaged in this time period, once you get around 5% or over 5%, stocks and bonds tend to have a persistently positive correlation. There's no reason to be owning long duration securities. Well, since we've been in this kind of post long-term LTCM kind of frame, regime, stocks and bonds have had an inverse correlation. This is what modern finance has been built on: risk parity, 60-40 portfolio, et cetera. And so what we're arguing with the stationary mean reversion model is that, hey, if we're right that the stationary mean of inflation is going to go from 1.8%, somewhere on this chart, to somewhere around 3% on this chart, it's probably not high enough to return to this period here, which is the persistently positive correlation between stocks and bonds. And so that tells you that at some point in this cycle, we're going to get a great opportunity to buy bonds. I'll be the first one to admit that we bought bonds too early, going back to the last fall, December, and most recently in February. We definitely bought them too early, but I do believe 6-9 months from now we won't care about having bought them too early, because again the cycle will start to take over and remind investors that if this red line isn't going to stay up here and it's going back down here and kind of trading in a mean that's again higher than what we're used to, but not quite as high as the 70s and 80s. That to me is a really important factor for kind of longer term risk managers to consider.
Two things on that. So we have a few months maybe before bonds, arguably aren't terribly helpful hedging your equities. But that LTZM, that was the ruble that broke the long-term capital management, right? Wasn't it? If I remember correctly.
That was, to me, that's the most important event in finance in modern financial history.
And now it is the ruble that is breaking it the other way. That's pretty fascinating.
Totally. That was the event that said that changed financial market, the reaction function of the Fed, from fighting inflation and price stability being the most important thing to growth and financial conditions being the most important thing.
Right.
And we've been in that regime ever since. And now you can make the case that at least for a brief moment, at least for the next, several quarters, the Fed is back in this old regime, which is why we have this positive correlation between stocks and bonds. We just don't think this regime is, going back to those 16 factors in the model. And if you guys want to come check that out, just, again, this presentation is $100. If you're investing capital markets and you can't afford this presentation, I don't know why the hell you listen to us after 56 minutes. But anyway, I digress. My point is, the 16 factors of this model, from automation to demographics to monopsony power to technology, wealth inequality, all these different factors, they're telling you that inflation is not going to stick around at 7-8%. It's not even going to stick around at 5 to 6%. It's going back to about 3% in terms of its average, which again is higher than we're used to, just not probably high enough to destroy the 60-40 and risk parity.
It's fascinating stuff. I mean, for the last 10, 15 years, it has been this Fed put, right? It's been the reciprocal feedback loop, buying the dip, right? And from a volatility perspective, I think that meant a lot of people enjoyed being able to sell volatility, right? And I mean, the dips only last a day over the last year. I think anyone can tell that this market is really quite different, and it's I will just leave with this one chart. On screen here is the liquidity tool from the CME, and this is showing the book depth in the ES the ES futures, right? The global sort of standard when it comes to equity futures. As soon as the Fed started to tighten, and I'm not exactly sure why this is, but as soon as the Fed announced basically they're going to change their policy, you could see the depth of book in the E-mini started to dry up. And this was with the equities at all-time highs, right? This is a similar situation that went into a lot of the major drawdowns that we've seen. If you zoom this chart back to basically March of 2020. So liquidity is dried up. Somebody asked a question about liquidity. Liquidity is dried up. You have to pay more spread to get stuff done. People are concerned about a lot of these risks. And so I think the bottom line here is that volatility is really here to stay. There's a lot of changing dynamics here, and it is different this time, right? In terms of the way you used to trade, right, over the last year, 2 years, the allocations, the things we're looking for, it is kind of a whole new world, and I think you can see that on your screen here, right?
Yeah. And if I can add one quick thing, I mean, what you and I do for a living is try to inform investors of a lot of these risks, and more importantly, we use our time and our experience and our acumen to track all this stuff, and synthesize it for other investors who may not have the capability or the resources to do this stuff. And at the end of the day, what we're trying to do is inform people so they don't lose all their money, right? Like,
right.
You don't need to listen to either Brent Kochuba or Darius Dale in a raging bull market. I appreciate when people listen to me, but the reality is you don't. When the size is going up 5, 6, 7, 8, 9% every 6 months, there's no reason to listen to me. When we go into a different market regime, a different economic regime, we're in the wrong point of the economic cycle, we're in the wrong point of the policy cycle, it pays to have, resources like this, in our opinion, to help you navigate the markets. We're not going to get every wiggle, right? I'm getting my face ripped off this week on a few shorts that we have. The reality is, if we stick with the cycle, it's very likely that, a lot of these positions, a lot of our views materialize because ultimately markets price in fundamentals over a long enough time horizon.
Right. So it's an excellent point. So, Darius, I think we should leave it at that because we're getting towards an hour here. Do you want to tell people again how to get in touch with you? It was a really good presentation. Thank you.
Yeah, thank you, man. Appreciate you, man. So yeah, at 42, come check us out, 42 Macro. I think we have 3 sample reports for each of our products out there on the website. Download them, check them out. This is what we do every day, every week, every month for our subscribers.
That's great. Thank you. And we're at SpotGamma.com. We're at SpotGamma on Twitter. If you have any questions that we didn't get to, try to leave them in the chat or the comment section below, and we'll try to get to those. And we, again, thank you, everybody, for joining us during these crazy markets. And so with that, Darius, thank you, man.
Thank you.
We talking soon.
Cheers. Cheers.